Let's bring on board Basant Maheshwari, author and portfolio manager at Basant Maheshwari Wealth Advisors, on the show. Hi there, Basant. Good morning. Good to have you on board. Many thanks for joining in. Now, yesterday when we chatted very briefly, you seemed to be fairly cautious, much in tandem with what the rest of the market experts are talking about. But you're saying that the worst is certainly not over for the markets. Is this indicating that we're in store for a bit of consolidation, or that we're in store for something far worse than that?
Good morning, Avan. I mean, when I say that the worst is not over, it means that the worst isn't over for the broad market. That's where most of the people are invested in, and that's where most of the pain is. And that's where people have been struggling for the last year and a half. And when you have a GDP growth, which is 5.5, and the jury is still out on the street, whether it's really 5.5 or 4.5 or 4.25, I mean, who knows what the growth is? In such an environment, you can't have the entire bunch of industries and sectors doing well. So when you can't sell soaps and shampoos and detergents, then it tells you about the mood on the street at that particular time. So keeping that in mind, and these things don't change fast. India is not a speedboat, it's more of an aircraft carrier. So you can't take a U-turn or a V-turn as we all want it to. So taking all that into consideration, I think the Nifty will not fall. But below the Nifty, the 100, the small cap, the mid cap index, they might not fall because you've already butchered them so much. All you're left with are the bones and the teeth right now. So what will you get out of them? But then in the market, if you don't make money for 1 year, that's as bad as anything, because you come to the market to make more than FD rates of return. So in that context, I think there's no magic on the anvil. We can't see any magic happening, and the accidents galore at the time. And the government in the first year of a new, normally the first year of a new government is where, you get a plethora of options, the reforms, but this seemed like a third year or a fourth year budget. So when you can't do things in the first year of a new government, I don't think we can expect any magic in the second or the third or the fourth year. So all that taken into consideration, I think it's a little tough and an uphill ride from here.
You've always been known to invest into high growth areas, high P multiple companies, and you've always argued by saying that the growth will take care of the valuation. What's happening now, in some of these high growth names, they are really taking it off. Does that tell you that, it's a very risk off environment?
So Pankaj, the thing is, it's not that we love buying high PE stocks. We are not fascinated by valuation. So, and PE, just if we are doing this discussion, let me tell you, growth is not one thing that defines the PE. The first most important thing that defines the PE is the entry barrier of the business. The second is obviously the growth. So 99% of the Twitter commandos are always equating PE with G and saying that PE is more or PE is less. Third is, you would find a great management always commands a higher PE. A second grade or a third grade management has a lower PE. Then the fourth thing, if you would look at it, is a sector leadership. The sector leader will have a higher PE. The bottom rung stocks in the sector will have a lower PE. Then the liquidity, a stock which is liquid will have more PE. The stock which is in the index, so index factor will have a more PE, we will have a higher PE, and so on and so forth. I can list 15 to 20 factors that define a PE, and not just growth alone. But if you were buying 10 PE stocks, then buying a 10 PE cement company isn't the same as buying a 10 PE soaps and detergent company. Some things come expensive, and you have to buy it expensive with a forecast that the growth that you envisage is going to make that expensive stock cheap over a period of time. It's a standard cliche that we keep using all the time. But then most people don't want to take that leap forward, because that's more into a leap into the dark tunnel. And most of the time, if you're doing that, the light at the end of the tunnel is from the train coming from the opposite side. So you have to be very cautious about what you're doing. Obviously, it's a problematic thing to be trying to envisage growth, but we've been doing that for the last 2 decades, and that's where our forte is, and that's what we do.
Basant, hard times when it comes to the auto sector, barring the flattish sales that we saw in October. Since the last 1 year, the sales have fallen every month for a long period of time. What exactly is your outlook, given the fact that we're seeing, higher fuel prices, rural income as well seems to be slippery? Is it looking very dire for the auto sector now?
No, it's good you brought the auto thing into place, because we were doing this back calculation 3-4 weeks back in office. So I think in December 2015, Maruti traded 4,600 rupees at a PE of, I think, 29. December 2017, Maruti traded at closer to 10,000, PE 39 or 38. Right now, Maruti trades 6,000 at a PE of 26, which is lower than the PE of 29 when it was 4,600. So at 4,600, PE of 29, people didn't want to buy it because you couldn't justify Maruti because it was an all-time high. Now Maruti is at 6,000, PE lower than 29, still we are not buying it because we can't see growth. So effectively, most of us try and equate PE with growth, and still we think that the higher PE is bad and lower PE is good. So to put the entire thing in perspective, when you have a 4.5-5% GDP growth and you're not able to sell your two-wheelers, you're not able to sell your motorcycles, you're not able to sell soaps, detergents, I think it's a tough game to be in. And if you look at it over the last 4 or 5 years, one big theme has worked in India, that's from economy point of view, that's the household work substitution. So tuition classes galore everywhere. The housewife who was teaching her own children isn't doing that. Swiggy, Zomato, Scootsie in Bombay, that's doing well. You've got people who are delivering food. So that's the only place you see growth. In the early part of this century, between 2000 to 2005, if you saw, call centers were being formed up everywhere. So I think this call center business, this time this is coming in, but this doesn't add to the productive activity of the entire economy, because food that was being cooked at home maybe 7 days a week is now being cooked 5 days a week. So you can't have multifaceted growth. Of course, we've tried so many things, Digital India, Skill India, Stand Up India, Startup India, but India doesn't seem to stand, doesn't seem to start.
Earlier, if 4 or 5 years back, if we would have talked to you, spoken to you, you would have spoken about the financialization, what's happening in various NBFCs, smaller finance banks, smaller finance companies. Do you think a lot has changed over there in the last 8 months? And what would be your view now on this financial pact? Stick to leaders? How would you approach this pact?
Experience has taught us the hard way that it's better to be with a sector leader and lose a little bit of money there, because then the chances of recovering the money back is quite fast. So in demonetization era, what happened? SKS Micro fell, Ujjivan fell, Equitas fell, again no recommendations. Equitas, Ujjivan never ever came back to those levels again. But SKS Micro came back to its own level again. So in the jewelry space also, stocks fell, but the leaders came back. So what we have learned out of all this game is stick to the leaders and stay there. And one thing in the small space banks, what has happened is the regulator is now looking at these banks a little differently, because the regulator is different right now. So during Rajan's time, all this concept was promoted of a small savings bank where you could go into the last mile and get the people to open bank accounts, try and have inclusive growth, the Jan Dhan scheme. We don't hear of that. So this new regulator is equating a small finance bank like a large scheduled commercial bank. And when the RBI normally tries to look at these banks in the same lens as the larger banks, then these banks don't get the benefit. So they all have an overhang. You have to list this company, you have to list that company. I think it's complicated. So there are several companies right now which look phenomenal in terms of valuation, in terms of fundamentals, but then valuations and fundamentals are fine. If there's an overhang, nothing works.
Basant, a lot of people would have argued by saying that if, what's happening in the aviation pack, the larger leader would benefit. But again, not taking names, but in Indigo, we've got, an issue come up with the promoters. How do you value this in the price? I mean, it's very difficult to do it, I know. But in experience, what have you learned when two promoters have issue? What happens to the price?
The price, this is not a fundamental problem in Indigo. No recommendation, we don't own it also. It's not a fundamental problem, it's a controlling issue where two people are fighting together. As long as they don't end up splitting the companies and say, let me keep 100 aircrafts and you keep 100, I think it's all fine. Because If you start splitting up the company, then it loses its operating advantage. I don't think they're going to split up the company, but if this continues for the next 2 years or 3 years, there'll always be an overhang. If this settles in the next 6 months, then this is phenomenal. So two things here. You have to take a call whether this problem, whether this fighting is going to get settled immediately. I think the institutions are going to get in and tell them, okay guys, you've had enough of this mudslinging around, sit down and settle it out immediately. Secondly, the problem with Indigo is, of course, it's a phenomenal thing, and with Jet out of the way, obviously there's a huge market to capture. The problem is the moment it raises aircraft fares, the government would come in and they would say, hey, you are charging a little too much. So with cement companies, with aircraft companies, of course we live in a free market society, but still there is the big brother who keeps looking upon them. And then there's the crude. But then I think the big call at Indigo, if you were to take one, is would they keep fighting for the next 3 years, or would somebody get in and tell them, okay, sit down and settle it out immediately?
I also want to get a sense, given what you've described on the growth front, we're also watching out to see what the Fed does and impact on rates and fund flows. You know, do you feel in terms of how attractive India's looking right now, you know, with respect to flows, that anything's shifted? We've got the FPI tax, so on and so forth. Again, just the kind of messaging it's sending out to foreign investors. You know, what do you feel the trend will be going forward with regards to flows, keeping in mind some of these factors?
So two things. India is a small cap in the larger capitalized global economy. So if there's a small cap with say 1,000 crore market capitalization, I mean, that management might be thinking my company is the best of the world, just as a mother thinks that her child is the most beautiful child in the world. But the fund manager doesn't care about that company. It says, if you can show me a certain set of attributes, I'm going to buy the stock. So right now in India, we have this own self-induced fallacy that we are the most beautiful destination in the world, and at one time we were a Sone ki chidiya and people would come looking for us. I think when a $20 trillion US economy grows 3% and a $2.5 trillion Indian economy grows at 5%, and still you're not sure where this growth is all going into, I don't think there's a red carpet welcome for a foreign investor coming into India. And without that, I don't think we're going to be identified as easily as we were by the East India Company 400 years back. We need to put some more effort, because we are not the India of the 13th, 14th and the 15th century. We are the India of the 21st century. And I think the sooner the government thinks about it, the better it's for everybody in the market, everyone together.
Interesting way to put it. Self-induced attractiveness, and as of now, lots more needs to be done, according to Mahesh. So that's another topic for later, which we hope to chat with you about. For now, we'll let you go. Thanks much for joining in, Basant, and giving us your take on the markets.
Thank you.